Hey, could you ask yourself what kind of investor you are? Not getting exact answers seems complicated, right? Well, if you can determine yourself what kind of investor are, you can grow your investment exponentially and secure your investment more effectively and efficiently. You would be wondered to know basically, in the stock market there are 4 types of investors. Active investors, passive investors, speculators and value investors. In order to grow your wealth or securing your wealth sometime, it becomes critical to know that in which types of funds should we park our money. Active or passive? So today in this video we will let you know which is fund right for you, active or passive funds. But before that, let me introduce, we are PE Wealth, a SEBI registered investment company. We offer stocks, mutual fund, PMS, AIF, insurance and startup investments. So now back to topic. Usually, when it comes to investing, one of the most important decisions you'll need to make is whether to choose an active or passive funds. Right? While both types of funds have their own advantages and disadvantages, the choice ultimately comes down to your investment goals, risk tolerance, and personal preferences. So now what actually active funds are? So in this, investments are buy and sell to optimize earnings in actively managed funds. The fund manager is in charge of conceptualizing and selecting suitable investments to execute a stock that outperforms the benchmark or index for the fund. Hence, to decide how assets are bought and sold, a fund manager needs information, in-depth research, and comprehensive know-how. Even if the fund manager is in charge of making his own decisions, they should be in line with the mutual fund investor's investment objectives. On top of that, choosing an active fund option could be expensive. The rationale is that fees are associated with the fund manager's competency. In fact, the expenditures ratio typically fluctuates between 0.08% to 2.25%, depending on the equity-debt direction of the fund. So here are some of the examples of actively managed funds. Like if you can see, in Tata Small Cap Fund, it has generated approximately 15% returns in 1 year, whereas in period of 3 years it has generated spectacular returns of 44%. Which means if you had invested 1 lakh rupees, you would have tripled your investments. Similarly, Nippon India Large Cap Fund and SBI Magnum Fund are also categorized as actively managed funds. So investors can look out for such funds for making stellar returns. In fact, if you're finding any difficulties while choosing active managed funds, you can approach to financial advisors. Now what are passive funds? Here, the portfolio management of passively managed funds is not actively handled by a fund manager. Instead, they just try to match the performance of a benchmark. Unlike active funds, their passive counterparts employ a buy and hold strategy in an effort to mimic the performance of a market index. In addition to that, the ETFs are managed passively. Exchange-traded funds are not governed by the fund manager, but with ETFs, the fund monitors and tracks index movement. Moreover, SEBI makes the decisions regarding ETFs, not fund managers. The index returns are changed into the returns of the ETFs. Charges made under the expense ratio, management fees, additional fees, or dividends may differ. So here are some of the examples of passive managed funds. Like if you see, in Motilal Oswal Nifty Small 250 Index Funds, it has dented your investment by -8% returns in 1 year, whereas in period of 3 years it has generated of 37%. But if you compare it with active, you have made 7% less returns. Which means, if you had invested 1 lakh rupees in this funds, you would have made only 2.5 lakh rupees, approximately 50 lakhs lesser than actively managed fund. Now, let's know the advantages and disadvantages of the both funds. So let's begin with actively managed fund. Active mutual funds have the potential to outperform the market due to the fund manager's active research and selection of securities, as well as the flexibility to adjust their portfolio holdings based on market conditions and analysis of investment opportunities. Another advantage of active funds is the potential to provide downside protection in falling markets. Active fund managers can adjust their portfolio holdings to reduce exposure to high-risk securities or industries, which can help protect the fund's value during market downturns. Now on disadvantages of active mutual funds. One of the main disadvantages of active mutual funds is the higher fees charged by the fund manager. In addition, since active funds are managed by humans, there is always the risk of underperformance due to errors in judgment or poor investment decisions. Another disadvantage of active funds is the potential for overtrading. Active fund managers may take frequent buy and sell decisions, which can result in higher trading costs and lower returns. Now, advantages of passive mutual funds. Passive mutual funds have lower fees than active funds because they simply track an index, requiring less active management from the fund manager. This can help investors achieve their long-term investment goals more easily. In fact, passive funds are simple and have fewer investment risks as the fund manager tracks an index, making them an excellent option for hands-off investors or those new to investing. Disadvantages of passive mutual funds. Passive mutual funds are inflexible and can't adjust their portfolio holdings based on market conditions or investment opportunities. This limits their potential for outperformance, especially in rapidly changing market environments. Passive funds can have tracking errors, deviating from their intended index, resulting in lower returns over the long term. Now, the most important part of this video: which one you should choose, active funds or passive funds? To consider adequate funds, it relies totally on the investor's aim and its risk tolerance. If an investor, for instance, desires more returns, he may choose an active fund based on his ability to take risks. In the same way, a risk-averse investor who searches for stable income may opt to invest in passive funds. The difference between active and passive funds is more because of their features rather than any fund. It is best to consult a financial advisor if you don't know what is best for you. He will suggest you the best fund, which suits your financial risk profile. That's it for today. For more stock research, mutual funds and investing ideas, visit our blog portal. Link is mentioned in the description box. Like and comment if you have any query.